Thanks so much for attending. Today we have a very interesting seminar. Essentially, we want to talk about why people leave the country, both citizens and long-term residents. And we do the analysis from the perspective of the IRS, really. We'll go through on our agenda basically the differences in treatment of both income tax and estate tax for residents and citizens versus non-residents and non-citizens. We'll set the stage for you with respect to how each is treated on the income and the estate and gift side. And that will give you the background necessary to understand why the IRS has addressed for about 25 years now this idea of imposing tax on people who leave the country. It's a very foreign idea to Americans in general because we have substantial freedoms, but the idea is that the IRS doesn't want people to benefit from giving up their citizenship or residency, and this is the tax that's imposed. So we'll talk about the background. We'll talk about the expatriation tax, which is what happens on the income tax side when you leave the country. And then we'll talk about on the estate and gift tax side, there's also a completely different wing for the estate and gift tax side with respect to expatriation and some ways to potentially avoid the tax. So as a backdrop, we are in the US, we're either citizens or we're residents. Without having to have a seminar on citizenship, the idea is, you either are born here or you earn your citizenship through immigration, etc. But what really you find in practice with respect to expatriation is the non-citizen resident. So when the non-citizen has come here for some period of time, they may be a resident for income tax and or estate tax purposes. The most interesting part of that, which is it's actually kind of amazing, I think, that it survived over the last 70 years, this distinction, whereas someone can be an income tax resident and not an estate tax resident. In other words, they pay income tax worldwide, but if they die, they're not subject to the U.S. estate tax. And that also allows for a lot of planning, but this expatriation covers both. On the income tax side, essentially, if you're a full-time resident, which there's a test, it's called the substantial presence test, and essentially, if you're here for more than half the year on average for 3 years, it's a weighted average, you're a U.S. income tax resident. And then when you leave, you're not. So if you're a citizen or you're a resident for those purposes, you're taxed on all income worldwide. So it's no major epiphany to find that people do not want to be taxed worldwide, right? So basically, they want to get rid of this encumbrance of being taxed all over the world. And where is it most appropriate? Where is it most applicable? Well, when people come here for a period of time and most of their income, because we're talking about the income tax, is coming from another place. So if your income is coming from another place, the majority of it or almost all of it, we have clients with almost all of it coming from abroad, you really aren't interested in the IRS taxing that income, especially if you can get a lower rate if you don't live here. So that's one really a very strong candidate for expatriation. We compare here the income tax for the citizen and the resident versus income tax for the non-resident, non-citizen, NRNC, right? And so if you don't live here, essentially you are only taxed on income that has a source here, which is you have passive income like rents or interest. And then you have an exception where you can buy and sell intangibles like stocks. Most people don't know still, many domestic tax preparers, this type of thing. aren't aware of the fact that foreigners, if you're not here, if you don't have a residency here, can buy and sell US stock without any capital gains tax. Buy and sell intangibles freely. I'll let Brian go through some of the oops, we've lost our way here a
There
little
we go.
bit. Yeah. Go, Brian, we'll go through the
Yeah.
estate tax side on the resident and non-resident.
So as Gary just explained, we have rules for the income tax side, which is subtitle A of the code. Well, for the estate and gift side, that's subtitle B. So the tests are different. And so as he discussed earlier, there might be certain individuals that might be an income tax resident, but not be a estate and gift tax resident. And that has to do with the idea of domicile. And for the estate and gift tax, domicile, if someone's domiciled here, it's their presence here in the US plus an intent to remain. If those two things are met, then you are, for estate and gift, a resident here and would be taxed in that way. However, based on other tests on the income tax side, that offers a chance to plan because you might be a U.S. income tax resident, but you can domicile yourself someplace else because it's not just where you're located; it's your intent to remain.
So it's not as formulaic.
Correct.
On the income tax, it's pretty formulaic. Are you here for more than half the year, essentially? On the estate tax side, it's kind of it's as facts and circumstances.
Right.
So you're creating facts and circumstances that suggest that you want to return home.
Right.
And if you could prove that you came in with the intent to return home, then you're not a U.S. estate tax resident. What's the upshot of that worldwide, Brian?
Well, I mean, so if you're able to not be domiciled here for the estate and gift, all of your assets outside of the United States when you die are outside of the net. When you would have some US based ones, for instance, if you had real estate here, but beyond that, and some other things like, stock, if you actually still own US stock when you die, that's also would be a asset. But if it's planned the correct way, you can avoid all the worldwide net taxation on worldwide assets. So with substantial wealth, that offers planning opportunities to avoid that if you're already here.
Exactly. Now, sometimes it's rare, but someone would want to be a U.S. estate and gift tax resident. Some taxpayers would say that's never the case, but it may there's an argument for that. But what happens when you become a resident is that, for instance, now you're entitled to essentially husband and wife $27 million unified credit. So if for some reason you happen to be a non-citizen, but you own most of your property in the US and you haven't planned, you can come in and become an estate tax resident and take advantage of that deduction. Also, the husband and wife, we have a slide here. You can move property to citizen or resident, really just citizen now, but if you have a special trust for a resident. But if you both become citizens, you can move property back and forth even when you die, and there's no tax until the second spouse to die.
Okay, so not only do you get the unlimited marital deduction if you become a citizen, but you can also defer your tax until the last spouse dies.
Exactly.
Which is important when you think about, where your assets are located and then, what you plan on doing with them at death.
Exactly. And here's some of the technical pieces associated with the non-resident, non-citizen.
Right. I mean, the main difference, at least from the perspective of the non-resident, non-like citizen, there are a lot of ways to gift certain things, gift tax free. One of them being intangibles during life, which, hopefully, if we have advised our clients and they're non-residents, non-citizens, they should never own anything like U.S. stock individually at death, because that would be extremely bad. They only get a $60,000 exemption amount. That's it for all U.S. assets at death.
Yeah, as opposed to it's essentially none.
And it's not indexed, so it doesn't go up each year. It's been that way since 1954, I think. Right. It's been a long time.
40% rate on what you leave here. Now, keep the backdrop in mind, and that is that if you are a non-resident, non-citizen, and you don't have any intention of coming to the US permanently, there's essentially a very easy way to avoid estate and gift in the US. So we're talking about people that this seminar is on expatriation, leaving, going back home, but also a lot of people, we just wrote a Florida Bar article on it, are considering coming in, even though they have a lot of wealth abroad. A lot of people want to come in and be with the family. Um, that's fairly easily dealt with if you have a lot of time. But the people that don't want to come in is very easily dealt with. In other words, if there's actual planning that goes on, we can set up an offshore corporation or similar entity. And that all of these US based assets that are subject to the US estate tax on dollar, essentially $1, there's a minor exemption, but essentially $1, are placed or bought initially in this foreign entity, and the entity doesn't die. So the entity, though, upon the death of the owner of the entity, whether that be an individual or, whether it's owned through a trust, there's no estate tax. So there's an easy fix, just to keep in mind. There's an easy fix if you're completely foreign, you have no interest in coming in. There's a delayed fix if you're foreign and you want to come in because you've got family here. What we're talking about today is what happens when you're here and you want to leave, right? What happens when you're here and you want to leave? And of course, if you're not an estate and gift tax resident, it's no issue. You just leave and you've never been an estate and gift tax resident. And the only thing you have to worry about once you're out permanently is getting everything into an offshore entity. But if that's not the case, we get into a more complicated expatriation tax. Let's see what else we have.
And just some strategies
Mhm.
to avoid from, as Gary was saying, from the outside, if you want to come in, there are strategies to keep the non-US side as that assets outside of the estate tax net before you obtain residency here. And that's one of the things that you're able to do beforehand, or if if a non-resident wants to acquire something in the United States, be it real estate, that's where the foreign entity comes into play. So just in case there's an unexpected death, they don't get the estate tax on the US based asset. Um, one of these would be a foreign trust. There are some special rules with that. If you're a US resident and you establish one, be careful. It can be utilized, but as long as you stay here, it's a grant or trust as long as there's a US based beneficiaries. If for any reason that's no longer the case, or you die, the person who creates the trust, then we have basically an expatriation of those assets. So a deemed sale occurs inside the trust on the income tax side. And that's exclusive of any estate and gift credit you've used to make the trust, you create the trust. So that's a distinction between income tax and estate tax.
And that's one of the few areas that where you have an intersection of income and estate, because that deemed transfer, that tax on the deemed transfer to a foreign trust, which if you have U.S. beneficiaries does not hit until the death of the U.S. grantor. If there's no U.S. beneficiaries, it hits immediately. Really has to be taken into consideration if we're going to fund a foreign trust. Usually, if it's a U.S. grantor, there are U.S. beneficiaries, and really there's no issue. But you have to keep in mind that this is a different seminar we're talking about. That this is what we're now hitting on is the expatriation of assets. We're dealing with people in general today here. We're going to hit that. But that transfer out for U.S. people, there's a death tax. There's a income tax when that occurs. Income tax when that occurs under certain circumstances. And so that income tax is unrelated to the estate as well, except that if those assets are subject to the estate tax, then you don't pay the income tax.
Because you get a step up in basis. It's been exposed. I know you have to have the background to understand
Right.
all these rules.
And
they operate together, and logically it makes sense, because if you put assets in a foreign trust, you have removed those assets from the US tax net.
Right. And that's exactly in terms of expatriation. of a person is the same idea. And we're going to, so that's a little touch on expatriation of assets. And if you're a non-resident, non-citizen, when you come in, and if you funded that foreign trust to drop them off outside, you have to do it after 5 years. If you don't do it after 5 years, it's like you're a US person funding a foreign trust and you have that same death issue. Treaties, we won't spend a lot of time on treaties, but there are a substantial amount of income and estate tax treaties. They'll lower the rates. Sometimes they'll eliminate the tax on certain transfers. Very, very significant depending on your circumstances. They're not that significant with expatriation, though. There's not a lot of treaty relief for expatriation. Here are some of the countries that we've signed treaties with.
On the estate and gifts side, that's really where I think that if a treaty applies, potentially there would be credits and things depending on the nationality of the person that would have the benefit of the treaty. But on the expatriation side, I think you're right. There's not anything.
There's very
Very
little. Yeah, the income is good because in terms of a treaty, if you're dealing with a treaty country, you're in the US, you're from France, you've got a treaty that applies to cover certain capital gains and certain double taxation issues, but expatriation, I'm not sure you're going to get a lot of relief from that.
And it makes sense because a lot of these on the income tax side, it's a deemed sale, not an actual sale.
That's true.
So that's why.
That's absolutely true, actually. So expatriation from the US, we had mentioned it's uncommon for US citizens to expatriate. It does happen. We really see non-citizens here for a period of time that want to go back, and that's considered a tax expatriation. The law is fairly complex and changed over the years a number of times. It's this 877 and 877A. Essentially, in the early 90s, what was happening was a foreign national would come to the US and would establish a business, usually similar on an E or an L visa to the business they had abroad, and grow it and build it. And it's based in stock or some equity. As we had mentioned, foreigners can buy and sell stock in the US at no capital gains. So what would happen would be, even if that person was a resident, right, of the US while they're building the business, they'd go back. They'd go back. And so now they're non-resident, non-citizen, which means they can buy and sell stock, no tax. So I guess we had, when push came to shove, they did a stock sale of this business, no tax on the sale of the business. This kind of got the attention. What happens is you had a budget reconciliation under Bill Clinton, and they're looking for cash. They're looking for a means to make the budget. What's the budget group called? The Congressional Budget Office or something.
CBO,
yeah. How do we show that all of these expenditures are paid for? And so this was one of those items where they were trying to develop some income for the budget. We're not going to let people come in, start a business, even though they're employing all these people and making all this money inside the US, and then take off and sell the business at no gain. That's where this came from, and that 877 was essentially based on that. Basically, there was a 10-year rule where you had to wait 10 years to sell and all this kind of stuff. And now it's kind of been simplified to an exit tax.
But it's important because 877 defines a bunch of terms, which are then used.
Yes,
in
it's not a throwaway statute. Yeah, they just revised it in the A part. Right. And so you're a citizen, you decide, okay, I don't want my passport anymore. You go through that process. There's also a substantial tax process that you cannot ignore, that we've seen people ignore. That's
much to their
chagrin. Not good.
Yes.
Yeah, and then basically what happens is it's going to apply to you if you're a resident with a green card for 8 out of the 15 years prior to leaving.
Right.
So if you don't have a green card, it doesn't apply. If you're not a citizen, no green card, this exit tax is not an issue. It's good to keep that in mind. You'll find over and over again, people will come in, they had the green card, they thought they gave it up. Sometimes they didn't give it up. They thought they did. Sometimes they gave it up and it had no idea there was an exit tax, which is the deemed sale of their assets. The issue is relevant when you have a client with the bulk of their assets abroad. That's when it really stings, because in the US, okay, if they have a gain, they have a gain. They're typically going to sell it anyway. But when it's abroad and they're abroad and they think they're free of the US and they had this deemed sale of all their assets everywhere, including the US and their home country, it's painful.
Also, too, just because the green card itself expires by the date, that's not a formal relinquishment of your status.
You have to go
We've
through the
seen that
tax
too.
process too.
Right, there's a process to substantiate that you are out.
And there's an exit tax, which is this deemed sale now. Now it's not a 10-year process, it's just a deemed sale of all the assets worldwide. And an inheritance tax, which is fairly complicated because it saddles, it's basically if you become a foreigner, you can give gifts that are from foreign property to anyone you want. There's no tax. Well, what they don't want is people to become a foreigner and then gift it back into the U.S. at no tax. And sometimes they have an increased basis, and it's like a complete mess. So you can't send assets back typically, and that's the inheritance tax.
Right.
We'll get into that.
Right, and it's just important to understand that it's so unique. It's the only tax on the estate and gift side to where the donee pays the tax, not the donor. It's a big difference.
The donor's gone.
Right. There's no jurisdiction over the donor. The
So
donee's here in the US.
They have to saddle
which makes sense.
with a donee, which is, contrary to the current US
Right.
gift tax rules.
And then as for, all this information about how these timeframes start for the long-term resident, it's when they obtain their residency start date, the RSD. And then, it's there in the slide, it explains what it is, but that's the date from which they would measure 8 out of the 15 years.
That's right.
And it's also the idea of being domiciled here. The individuals decided to come here and reside here. Their intent's to be here. And so that's when it starts.
Well, it's both.
Right.
Because remember, it's even more complicated. The exit tax is an income-based tax, and the inheritance tax is an estate-based tax. So if we haven't lost you yet, the income side, the deemed sale side, is based on the income tax substantial presence test, right? It's based on you being here a certain number of days per year. The cocktail party rule is 120 days. If you're not here 120 days a year, then you will not exceed that average, which is in that substantial presence test. But that's just the income. On the inheritance tax side, which is that gifting back, it's based on estate. It's based on were you here with the intent to stay, and did you give that up? You can see where this stuff starts to really go bizarro.
But it also allows for planning. So that's why it's good. I mean, it's complicated, but that's good too, because it allows your clients to take steps to avoid a lot of these pitfalls of taxes. As for expatriation itself, 877 was the initial rule, then it was revised in 04, I believe, and then it lasted for a short time, and then in 2008 they passed the current law, 877A, which now applies. We've had some in the past where we had some clients that were in that transition time, but I would think now it's almost been what?
Yeah, it's been so many years. That's right. Where they expatriated before 08 and they came back and in and out, and they're just trying to figure it out. But that's rare now because that was quite some time ago.
Right. And just from the overview of 877, Next slide.
Yeah.
You know, it had this rule until 2008. It was its 10-year taint, but that is gone now, at least unless it occurred and now someone's finding out later that for the most part is over. But the definitions are important because for a long-term resident to be covered, there are some threshold rules, prong test to where if they meet any of those tests, it applies. And those are laid out in the original statute.
That's right.
And
so
they are
there
here.
are really exemptions, but you have to satisfy
Right.
all of them.
Right. And so that's why that's here. So number one, they average the annual net income tax for the previous 5 years for the person who's trying to expatriate. There's a threshold. I believe it's 183 for 2024, the last 5 years. So if they exceed that, they're covered.
They're a covered expatriate.
Right.
You're done. You can't
Done.
use the other two exemptions.
Right. The next is the net worth of 2 million. There are ways to potentially plan around that when you actually, because it's a snapshot of when you actually leave. So by using a domestic planning strategies on the estate and gift side,
yeah.
you can lower your net worth potentially to avoid that.
Sometimes you have the spouse issue too. Sometimes the spouse is an expatriating. People are always saying, "I'll just give it to my spouse." The problem is, the spouse is going to expatriate too. So you're not getting anywhere. Sometimes the spouse doesn't, and you can move assets over and expatriate. Yeah.
And then lastly, even if you can avoid the first two, if you don't certify with the IRS that you're leaving, which we had a case of that before, where even if you are able to avoid the rest, you're covered. And that's important for two reasons. One is the exit tax on all of your worldwide assets when you leave. The other is from then on, you're tainted. So any gift back to a U.S. beneficiary from then on, you have the inheritance tax.
And you can imagine, so a lot of self-help type clients would say, no, my income was lower, and 90% of the time, they're thinking about U.S. income.
Right. Okay. Of course.
So it's
U.S. tax, right?
It's not. No, it's not. It's also the 100 million that came out of Rio. You know what I'm saying? It's also, so that's one thing. The other practical. I mean, on the 2 million, we talked about the movement back and forth, and they'll also link that to the U.S. I'm not sure what it's just ignorance basically, but they won't know about the certification. There'll be an answer with respect to income and net worth, but they won't know about the certification. And what's interesting is very few tax preparers know about the certification, and it's quite involved.
It's interesting, and it's not just you, the individual relinquishing the green card. It's a separate matter.
Oh yeah.
With the IRS. Well, I gave up my green card. No, that's on the immigration side. This is on the tax side, so it is different. Talked about that already.
Right. This is the taint.
The taint. I mean, it's just it kind of gives you a flavor for what the law was and the idea. But even with the problem with the 10-year taint from the perspective of the government was you could still avoid this tax, and so people would just wait 10 years.
That's a good point.
So with the exit tax, once you file, that's it. Now the exit tax, it applies if you're either a U.S. citizen or a long-term resident. And what it does is if it applies, if you're covered, as they say, it deems all your worldwide assets as a deemed sale mark to market as the date that you expatriate, income tax side. And, that's a big deal because you're paying this tax on the income side, but you will not get a benefit through a tax credit or anything if you expatriate and you're gone. You're no longer an income tax resident after that. You have this massive tax you have to pay, but you haven't sold anything. Big mess.
It's a complete mess. But now it might be attractive to certain clients. I mean, certain clients with very little built-in gain in their assets, there's an argument that you, of course, you're still entitled to get rid of your house at the
Yeah.
credit with the exemption. So there, it really depends. And for instance, if that same client doesn't have a lot of built-in gain, but has a huge amount of bonds or something like
Cash.
that, or cash, and earns a massive income on that, and they're tired of the rates in the US, or they have a huge amount of bonds abroad. And they're like, well, if I just live in Ireland, or just live in, whatever, Malta,
Monaco.
yeah, I exactly. I'm at a minor imposition of tax. And so those people without the built-in gain, it starts to get interesting. You just have to be careful on this inheritance tax side, because they're typically very wealthy. Although we have had some exceptions, a lot of the times where they step into problems, they're wealthy, but not that wealthy because they don't have the guidance. We did have a very wealthy family though, completely messed us up. It's true.
That's true.
So as you guide the client, you have to realize that if the kids are here and the client is a citizen, it's going to be hard to get assets back into the kids. If the client's not a citizen, it may be overwhelmingly valuable to expatriate if you don't have a big built-in gain.
And then these are just the rules, and it goes back to the 877 rules from before, the net worth test, which is interesting. It's not indexed. It's been 2 million for a while. And then of course, I guess I was asked spoken, it's 201,000 for 2024. For the average 5-year test, if you did it in 2024, looking back.
Isn't that funny though? I mean, the reality is, I mean, when I spoke to the IRS head of international, I actually spoke on that one where they messed it up, the wealthy family. I spoke to the head of IRS International in Florida, and that was like several $100 million, and it was too small. It was too small for them to look at. So I'm not sure that this $200,000 I mean, compliance wise, you're going to comply practically that issue. I'm not sure that's like a major issue. And I can assure you that people making less than 200 grand with less than $2 million, essentially none are complying. Essentially none are compliant. Really.
Really,
I mean, we see just so much non-compliant. So it's really a question of high net worth people, I think, in general, in light of the enforceability. But if you do have someone who is, on the fringe of it, it's worth running the thresholds.
right. And also coordinating on the immigration side as well, because you've got the tax side and you have to do both if you really want to leave at that time.
Oh yeah.
That's missed a lot of times. But as we said before, it's if the exit tax does apply, it's an unintended tax sale of all the worldwide assets. It's as if you value it as if they died on the day before expatriation, a lot like the estate tax in a way. You would get an adjustment on the U.S. side for the deemed sale because you pay tax on it. But if it's worldwide, I don't know if that actually matters. You do get a credit amount. It's indexed, but it's not that much. And there are ways to defer the gain on certain types of assets with a bond. On the inheritance tax side, it's a little more complicated as it relates to the calculation. But if the exit tax applies to the person who leaves, any gift back from a covered expatriate to a U.S. donee, there's an inheritance tax, 40%.
Yeah, 40%. So it's the highest rate. It's
like
the
estate
highest
tax.
estate and gift tax rate. So think about it. The client decides, okay, I want to expatriate, whether it's a citizen or a long-term resident. You won't believe how many long-term residents actually do this, and so how few actually comply. Because, okay, I don't have a lot of gain. It's mostly income assets that don't have built-in gain. I'm going to leave. I'm going to incur a small mark to market hit, but most of my stuff's abroad. Now, so now they become full non-resident, non-citizen, and the non-resident, non-citizen is free to give anything away. That's foreign. So you have this foreign based asset, foreign based income, and they want to get assets in to even a vehicle that's caught or directly to their kids. It's very problematic with this inheritance tax. And what's interesting about the inheritance tax is it does not expire.
Or it goes away.
And so it's always this push and pull. And when it becomes really difficult and interesting from a planning standpoint is when the matriarch or patriarch leaves, they figure it out, and they've got kids abroad and kids in the U.S. And if they give it to the kids in the U.S., they get hit with the inheritance tax. Not easy. So it's the 40% rate. There's no step up in basis.
What's interesting though is on the inheritance tax, when the donee pays the tax from the covered expatriate, even though they pay 40% tax, there's no step up.
No, there's no step up.
It's just a tax.
Yeah, there's
unlike the estate tax, at least you get a fair market value step up. But in this case, you pay this basically the same tax, but there's no step up.
Yeah, because the idea is that we're going to treat the person who expatriated as making a taxable gift.
Right. Basically, yes.
You know what I mean? It's essentially it's tough.
So you get hit on the way out and then hit back when you give something back to the US, just to discourage this type of activity, basically.
Exactly. Here's the logic. There's the logic. We just went through.
Yeah, there's logic. The idea behind this is that if an individual leaves, yes, they pay a mark to market when they leave if they're covered. But then the idea is we've done this when you're trying to avoid the estate tax. Well, we're going to basically impose an estate tax, gift tax on any gift with like zero exemption from then on. And this taint basically, it's like the 10-year taint, but it never goes away for the expatriate. So from then on, anything that's inbound, they're paying 40% for the rest of their life, which,
And I think we mentioned in one of the slides the ratio. So if get real complicated,
right?
Because if you create an offshore trust,
It's like
and 2 of the 5 kids are
it's like
in
the
US.
G as in G in a way to where you have an inclusion ratio, what part is covered, what's not when it comes back in. Can be complicated. That's something else you
they're
just
trying
have to worry about.
They're trying to get to what's going back into the US and tax it.
Right. From then on.
Right. So well, let's see if we finish up this. Okay. This is pretty.
Yeah, it just goes into
granular.
the definitions. I mean, when you read this, if you go in the code and try to understand it, there are some examples in the regs, but basically, who is an expatriate? What does that mean? Who is the U.S. donee who receives the gift, basically? And it can also necessarily have to be someone that's an individual. It can also be a trust or a foreign trust. So to be careful, you try to get around these rules. They've thought of these things. So if you're covered, when it comes back in, you're going to pay this tax.
The recipient's going to pay,
right?
And it's a little ugly,
right? And then here are some exceptions, because there are, of course, it would be the IRS and the code if there weren't exceptions in all these rules.
And also their planning options,
right,
as well.
Number one, I mean, if it's a taxable U.S. gift, you pay the gift tax. So I mean, it's
Well, you use up your credit.
Right, right. But if you're gone and you're no longer a U.S., but I mean, yes, you would have anything
before,
right? Then of course, if it's subject to the estate tax, right? Because it gets a fair market value step up based on the being exposed to the estate tax. Obviously, the government wants to encourage like giving to charities. So if you give to that and you're a covered expatriate, there's no inheritance tax on that. Transferred to a spouse
who's not going to expatriate.
Right, right, that's right. If there's a qualified disclaimer, that also would be an good such as if someone's gonna get something and they say, I don't want it, or the covered one does, they inherit from somebody else. I don't want this, and it goes to another person that's in the US, and it's not gonna be covered. So it's just one of those things, and the same rules apply for 2801 as they do for the estate and gift tax, because that's where it is. It's in subtitle B. It's all based on the idea of domicile. Does it cover or not
Right. So if you're
for the US bank?
trying to avoid it, you're constantly creating evidence and living in a certain way that suggests you're going to return home. Right? So you did not land here with the intent to stay forever. And here's why. And so if you're not domiciled, this does not apply. Now that may not be true for the income tax. So if you're here, that more than half the time, half the year, and that's true as a weighted average of 3 years, you're going to get hit with that exit tax, that real expatriation tax anyway. But if you think about it, there's a lot of planning you can do with respect to, well, okay, instead of me waiting till I'm here under a green card for 10 years, I'm in my 6th year. I see my tax advisor, and the tax advisor says, in 2 years, you're done. And so within the next 2 years, well, what do? Well, we consider not being a green card resident, which does not make them happy usually at all. Sometimes they're actually working, this type of thing. And on the income tax side, and then on the estate tax side, well, maybe we start to move some of our possessions, some of our people, some of our operations abroad, as if we're moving back. There's a number of cases on it. I wrote a couple of books on this. If you guys want a copy of the book, just let us know. But there is a lot of planning here. It seems onerous, but the reality is it's an 8-year plan on the income tax side with the green card. So there's plenty of time. It really hits people in our experience who just haven't planned at all. And then on the inheritance tax side, well, let's not be domiciled here. Let's start to work toward, depending on their age, whatever, not having the intent to stay here.
I also think it's important too, last thing on 2801, if the US it's like donees who are going to receive any of these covered gifts, if they're also a green card holder, they could potentially domicile outside of the United States and no longer be a US resident. So there's a planning opportunity for those types of individuals to avoid the inheritance tax.
It's kind of a shame.
Ways. Yeah.
In some way, it's kind of a shame, this type of tax, because what happens is, I'm not sure it's happened in this regard, like a Patriot Act type reaction, but it kind of discourages investment in the US, because a lot of these investments require the person who's got the expertise or the wealth to come here for at least for some period of time. And I don't know if that's ever been determined, whether, the tax received is greater or less than the loss of income tax revenue over the course of this person's life and at death. Usually they just calculate the amount of tax that might be, but for the budget that may be created. But I really don't think they consider, like, well, okay, what's an estimate of the amount of investment in the US that's been foregone? I bet it's substantial. These things, people just don't want to deal with it.
Right.
All right, we're starting to close up. There's the calculation of the tax. It's the 40% deal.
That's just
If you have any questions, let us know. We're here now, and we'll give you our contact information here soon. I want to make sure we're rolling. Yeah, we are. We have 5-minute question period now.
There are some things, as we discussed before.
Here you go.
You can mitigate some of this through planning. At least as relates to the net worth test, for sure. You can use domestic, like strategies to lower your wealth, and you can use your credit if you're here in the US before you expatriate. There are expatriation types of trust on the foreign side that might be something you might be able to do, especially if you can like fund those with US cash, because there's
No gain.
no gain on that. You can do maybe some domicile planning if you're a long-term green card holder. As we discussed, the sale of the personal residence is excluded from income, and then that's basically it. I mean, on that side.
Well, as an example, on the, wealth side and the estate side, I mean, if you have substantial wealth and you're worried about a triggering, but you don't have $200 million, you've got $15 million. We can get your wealth down. It's just estate tax planning. So in essence, so if we move assets into a trust for your kids and you keep income, well, the income's going to have a value, but your net worth has fallen substantially, and now we have this huge exemption. Sometimes we can get you down under the 2 million of personal net worth. Not easy sometimes, but if you fall into just the right
See, income, a
asset.
lot of times is the tough part. Income
Oh,
tax.
the income stuff. Yeah, the
That's
income
tough. I
could
mean,
be.
you might be able to plan for that, but that's probably, you can plan a lot if you're in a certain spot for
Right,
wealth, but
right.
it's really tough.
If you're not exactly in that sweet spot, it's
Right.
difficult.
It's very,
That was
very
my
difficult.
point. That's right.
It's just,
This is some more mitigation
Yeah.
strategies.
then I think the important thing here is that who a covered beneficiary is with the inheritance tax. It's not just an individual; it can also be a trust, and that's something that is lost at times. Oh, I'm not, it's not going to an individual; it's going to a foreign trust. Well, it doesn't really matter if the foreign trust has U.S. like bennies. It's going to be something where the trust, when it actually comes out to the U.S. Benny, they're paying the tax at some point.
There's our contact information.